Hi, today we are going to start a new topic on financial forecasting, which is very much related to chapter 3 topics because in chapter 3 we analyze the income statement, balance sheet, and cash flow. And for today's topic, we are going to forecast these three statements. Pro forma income statement is going to be forecasted income statement. Pro forma balance sheet is going to be the forecasted balance sheet, and cash budget is going to be the forecasted cash flow. Because businesses want to look into the future and be able to forecast how much sales they are going to have for the next year, for example, so they know how much cash they are going to need to be able to sustain the asset increase for this level of sales, how much money they need to borrow to sustain a growth of the company. So forecasting is very important. So I provided for you this PowerPoint for chapter 4, and I am sure you read the slides up to this point, the introduction on forecasting. And for this recording, we are going to do the pro forma income statement, the first one. So we have we want to look at the anticipated profits for the next period. And the steps to follow to develop the pro forma income statement are we have to figure out first the sales projection, how many units of each our products we want to sell the next period, next year usually. And based on our forecasted sales, we have to calculate production schedule, how many units we have to produce, because the number of units that I want to sell are not equal to the number of units that I want to produce. Why? Because I have the beginning inventory that I don't really have to produce this period because it exists from the previous period, but I have to uh, take in consideration some of the ending inventory, so I do have to produce that one. And then to be able to finalize the income statement, pro forma income statement, I have to consider other expenses and do the calculation all the way to the earnings per share. So let's see what do we have for our business. What do we think we are going to have projected sales in units? In units, then in dollar sales. So a simple example for this business, suppose they produce two goods, wheels and casters. So they want to sell next year 1000 wheels, that's quantity, and 2000 casters, quantity, and they want to sell each of them, that's selling price per unit, for $30 per unit and 35. So sales revenues in dollars, quantities times price, how many units they sell times price per unit is going to be 30,000 for the first good, 70,000 for the second good, 100,000 for both goods. So those are the projected sales in dollars, 100,000. Then we have to figure out the production schedule based on the previous slide, how much units I want to sell. Now on this one, we try to figure out how many units we have to produce of each good. So to be able to calculate the production schedule, we have to consider beginning inventory in units, sales projection in units, how much I want to end up in ending inventory. And that's the formula that I'm sure you learn in your accounting class. Production requirements in units is projected sales plus ending inventory minus beginning inventory. Well, I don't have to produce this one. This is why we have a minus, because we already have it in beginning inventory. So that's the production requirements. And on the next slide, we are going to apply this formula to calculate the production schedule. So for wheels, we went to cost of good. The cost of production for each of the existing units in the beginning inventory is for the first good. So let's see how much I have in my beginning inventory. 85 units. And it cost me last period $16 per unit to produce wheels. One wheel, it cost me $16 per unit to produce. And total cost for wheels beginning inventory, number of units times cost per unit equals value. And for the second good, the same. I have beginning inventory 180 units times cost per unit 20. It cost me 3600. Total beginning inventory cost 4960. I just want to ask you to remember that this is a cost per unit, it's not price. Sometimes students are confused between these two elements. Price, I only use it when I calculate sales, money that go into my pocket. Cost, this one, cost of production, is a cost element. It costs me money going out of the pocket to produce the units. And also, this is going to be cost per units previous period. Next period, this period might be higher. Sometimes when the cost of production increases because of utility expenses increases or any other raw materials expense, then those numbers might go up. So that was the cost of beginning inventory. And then we are going to calculate production requirements for the 6 month. So for the next 6 months, I want to produce 1000 units. This is how much units I want to sell. Then I want to end up with 10% of them, which is 10% of 100 units in my ending inventory, and I subtract 85 units, the existing ones. So the production requirements for the 6 months for the first good is 1015 units to be produced. We do the same thing for the second good, casters. I want to sell 2000 units for the next 6 months. Then I want to end up with 10% of 2000 at my ending inventory, 200 units, and I subtract the existing beginning inventory. So that's my production requirement here. So next we have how much is going to cost me to produce new unit this period. Remember, my old cost per unit was $18, was $16. Now the new cost per unit is $18. So it cost me $2 more per unit to produce one wheel. The same for casters. If you go back a few slides, old cost per unit was 20, now it's 22. Because we have an increase maybe in raw material or in labor, that's going to translate in higher cost per unit. So now we are going to incorporate that into total production cost. So recall a few slides back, I want to produce 1015 units times $18 per unit. Total cost, new cost of production for the new production is $18,270. And the same for the second good. I want to produce 2020 units times 22 new cost of production, 44,440. Total cost of production is going to end up 62,710. Now I'm going to continue with a new slide, with a new recording, because I prefer to keep recordings shorter, easier to upload.